Hey everyone, it's John. It's time for a general market update. It's June 23rd, 2023. So as a reminder, this is a presentation by Rain King LLC. I'm an amateur individual growth stock investor, not affiliated with IBD or MarketSmith. So here's our agenda for the day. We are going to be going over bookends today. We're going to look at the very long-term picture of secular bull markets, and then we're going to actually end the presentation looking at the short term relative to the indices. We're going to cover the January breath thrust and the pullback watch. So let's talk about secular bull markets, and I mean the really long term here. So when we look at something called secular super cycles, this is actually a chart of the Dow Jones Industrials on a monthly basis, just a line chart. And I want to point out a couple things. The market can move in major bull super cycles. And I've shown this area here, which is 1937 to 49, where the market essentially went sideways, marked by the 1942, which was a major low. When we broke out, we ended up on about a 25-year bull market. Then we went into a period of sideways consolidation between 1967 into 1982 from a very long-term perspective. We did have the 1974 major bear market forming a major low. When we broke out of the consolidation, we had a 26-year super cycle bull market. And then from 2000 to 2016, we essentially went sideways for a long period of time, including the financial crisis in 2009, creating the 2009 major low. And if you believe in super cycles, a projection for another 25, 26-year cycle of bull move would bring us to the year 2035. Now, we've looked at some of these periods before, and we're going to, again, this period from 74 to 2000 and the 2009 to current. Now, those of that you know, Chris Schiavocco did an in-depth study relative to super cycles, and you can check out his YouTube channel to get all the details. So what I'm going to tell you is based on a little bit of his research. He actually did a measurement from where we are currently from the 09 low to how many days we are currently away from that low. And then what he did is he plotted that from the major low to the same point that we are, from the 1942 low and the same point. And the question asked was, well, how much meat was really left on the bone from that point in the super cycle? Now, it varies a bit because we had this explosive exponential move in the NASDAQ from 95 to 2000. But if you look at it on the S&P and you look at kind of the angle of ascent, with this one being kind of extreme. So if we look more at this type of angle of ascent, what he came up with was using the S&P, we have approximately 150 to 200% range of potential gains from where we are today. So it's an interesting perspective on where we are in the very, very long-term picture. So examining the 74 to 2000 super cycle, the 74 bottom ground its way higher for almost 10 years. And people thought the market couldn't go any higher by 1982, 83. And what happened is the demographics were in our favor. The baby boomers were entering peak consumption years, and the market went into a major bull phase where there was an 800% gain in 16 years. Now, that said, we did have to endure at least 3 bear markets along the way, which are normal. I've shown before in these videos the super cycle from 2009 to potentially 2035. Again, the similarities are a 10-year period where the market went up, in this case 350% to 2019, and people felt we couldn't go any higher. But the demographics are in our favor again. There were 84 million millennials entering peak consumption years in this 2018 period. And so the millennials, many of them turned 40 right around 2021, entering peak consumption. So we've had multiple bear markets, and we're still coming out of this particular bear market. And the question is, if we're in the super cycle, we still have a period of 12 years of peak consumption ahead of us, where millennials are buying cars and houses, insurance and financial services, and the boomers are retiring, but they're buying second homes, healthcare, and transferring wealth. So the point of this exercise is there could be another 12 years of the super cycle that we're currently in. Now I've pulled this chart. This came directly from my market video, January of 2022, when we had just started to enter the bear market. And one of the things I had done at that time was I identified that, this market could come all the way down, and I had said at the time, to the 11,000 area and still remain the bull supercycle thesis. You might not have really recognized at the time, what was he talking about? Well, again, I was using some very long-term trend lines. This is from the January 2022, and I had drawn some really long-term trend lines to say, we were up here. I said this could come all the way back down to potentially the 11,000 area and still be in the super cycle. So this is the chart as it looks today. As you know, we've come all the way back down, and we got into this range between 10,000 and 11,000. Undercut it slightly for a couple weeks, but generally we've turned back up. So it seems that the long-term trends are still holding, which I think is an important view to have in the back of your mind. Now let's get a little bit more granular into what's been happening since January. Now this, again, I talked about, we had a major breath thrust in January 12th. Go to the January 27th video from this year, and I explain the whole breath thrust, where it comes from, what we were looking for. You should definitely watch that. And this slide also is taken from the January video, where we were setting some signposts of what were the forward expectations from a typical breath thrust, which was fairly rare that we had in January. And at the time, again, this is from the January 27th video, we had set some signposts. We said, look, after 3 months, we should be up at this level, 6 months up here. And then we said we could have the fact that the January trifecta was in play could bring us all the way up to the top at new highs. So let's take a look now at where are we? So this is the same updated chart. Here is the breath thrust we had on January 12th. And I've put the same markers in place that I showed in January. The 3-month marker in April of this year should have brought us on the S&P up to 44.61. You can see here in April, we were lagging behind. We had not gotten what we call the typical, in this case, a 12% gain in 3 months. We were lagging behind. Now, the 6-month marker was set for July. We're not there yet, but at the moment, there's still quite a gap between where we are today and what the typical breath thrust would produce, which was an average gain of 17% up to the 46.60 level. So we're kind of trailing behind and lagging from where we thought we would be. It's important just to have these as signposts. Now, the January trifecta, after a down year, typically produces a 28% gain, which would bring us up to the 48.76 marker, which still seems to be in play. We still could get there. So it's important just to kind of keep this in the back of your mind, where we are in the context of this last breath thrust. So let's get into the pullback watch. This slide I've gone over the last 2 weeks. I won't go over it in detail here. You can just pause your video or go back to the videos from the past 2 weeks. These are things that we were looking for to analyze on a pullback. Now, on this pullback watch, on the news front, and I really emphasize, we only care about how the market reacts to the news, not the actual headlines and news. Now, Powell's testimony yesterday, there was a quote which was really important, I thought. The Fed fights inflation by slowing the economy through raising rates, which causes tighter financial conditions, such as higher, as a typo, borrowing costs, and lower stock prices and a strong dollar. I've emphasized and underlined lower stock prices. It's clear that the Fed is trying to tell the markets that they're going to raise rates more and talk down the current rally. Now, the Fed raised concerns about sticky inflation. Now, I guess I'd put it in perspective that, the Fed didn't see inflation coming with its transitory comments in 2021. Will the Fed be able to see inflation going out the back end? Now, the markets have been seeing maybe one more rate hike, but what if there are more rate hikes to come, possibly 2 or 3? Well, the market has not priced in more than one hike. If we start to get more hikes, it could strain the financial stocks to become further stressed, and we're seeing some stress yesterday in the XLF and the KRE regional bank ETFs. Now, growth names, which have been on a strong move up, for the past month, they're stretched. Now, if the market has to reprice these lower with a terminal rate of 6%, there could be some adjustments made relative to growth stocks. But more importantly, we just want to watch the technicals, watch the action, and watch the pullback carefully. So how are we doing? Well, the S&P 500 is the chart I have up here, and a couple things we wanted to look at. Here are the key levels we talked about. We said a 3% pullback, which would be completely normal, would bring us into this area, which right now coincides with about the 20 exponential moving average, be completely normal. Even a pullback down 5% would bring us down to a zone where we'd be closing this little mini gap in the S&P. Then again, this would be considered really normal action. It'd still be above the 50-day moving average. I would get more concerned if we had an 8% pullback, which brings us down below the 50-day moving average and below the line of resistance at 4,200. That would be of concern. I also mentioned that I was going to be looking at the new highs very closely on the pullback and see if they can maintain the 50 level. And I've got here new highs in green, new lows in red, and I've drawn this dotted line, which is at 50. You can see we've tucked down just a little bit. The first 2 days we were above 50. Yesterday, I believe it was 43 new highs. So we're teetering right there. We're going to watch this really closely. If we can still straddle this line on the pullback, that would be bullish. If this deteriorates and the new lows pick up and the new highs disappear, that would be very concerning. Yesterday was not a good day in the market, and I tweeted out this morning, when we see bad breadth on an up day, and yesterday it was 2-to-1 down, that's always a concern. So we want to watch this very closely if the market is going to hold up or deteriorate. Two other charts I'm concerned about a little bit. This is S&P above the 200-day moving average. It looked encouraging last week, but we've had a sharp reversal. We expected it to come down slightly, but a sharp reversal is a little bit of a cautionary sign. In addition, the New York Stock Exchange advanced decline line reached this resistance area, and again, sharply is what concerns me more. This really got turned away hard yesterday as financial stocks really received some pressure. So this is cautionary signs as we watch the pullback. So I wanted to share a little bit more about preparing for a pullback, and I wanted to eventually share a hack that I use that may or may not be helpful to you. So as you're building your portfolio, you need to be very careful about your risks. You know, we have portfolio risks at the bottom of the cake. We have industry and sector risks by how concentrated we get into sectors or industries. And then, of course, we have individual trade risks with individual stock names. We need to manage all of this. Now, I wanted to talk about be careful about your exposure getting too concentrated in one particular industry or sector. So a rule of thumb would be don't get more exposed than 25-30% in a sector. Now, we know that a normal pullback, and we have rotation going on, let's assume you could have a 10% correction in the indexes. And we know from history that individual growth stocks will correct 2 to 3 times the industry or the sector. So if we get a 10% decline in the index, that would potentially mean a 30%, 20 to 30% correction in growth stocks. So keep that in mind. Now, example of this would be if you had a $100,000 portfolio and you were buying 10 different names at $10,000 a piece. Let's assume you had $30,000 allocated to the software sector and you had 3 stocks. If we get this 30% correction in this portfolio, that's a $10,000 hit. So that's concentration cuts 2 ways. It's great on the upside, but you got to be very careful about what it's going to do to your portfolio in a correction or a pullback. So I wanted to share a hack. The first thing you need to know before you're preparing for a pullback is you want to really know what is your average cost and draw the line on the chart. And also measure from the current stock price to the average cost. How much of a decline would bring it back down to your average cost? Do you have enough cushion to hold through a pullback, knowing that growth stocks could pull back 2x or 3x the indices? So here's an example. The market is extended and starts to pull back. Let's assume that you have 5 stocks. And the first stock, you're up 50%. The second stock, you have a 4% gain. The third stock, you have a 7% gain. And then stocks D, you're at a loss of 3%. And you're currently holding stock E, which has a 6% loss. So we anticipate in this example, the market's going to pull in. So you can see we have two stocks with rather small gains, and we have two stocks that have small losses. So here's the hack that I have used in the past. I try to balance small gains with small losses during a pullback, meaning I will actually close out these positions that have small gains and small losses to brace myself for a pullback. And what I'm trying to do with this hack is I'm trying to protect myself to hold my big winning stock, in this case, stock A, because I want to hold that through the pullback. And the point is, if you only cut the losers on a pullback and your small gains actually get erased and go back to zero or become negative, you're going to erode the big profit in your big winning stock. So the hack is try to balance small meaningless gainers and losers to cut those positions, and that gives you sitting power with your big winner. If I get rid of all these positions, then I can actually try to sit through a pullback in my big stock with my biggest position, hopefully holding on for it to resume its uptrend. So that's just something that I use. It may or may not be useful to you, but I just wanted to share it. So the summary this week. Well, the Fed is stating that rate hikes are not over. That could upset this rally if institutions have to price in a potential 6% terminal Fed funds rate as they're talking. So all we can do is watch the pullback for clues. We want to see a constructive pullback in the 3 to 5% range, and we want to see if the institutions are truly accumulating stock and prevent decline from going deeper. If the decline does go deeper, 8 to 12%, that would be a negative for the market. We'll have to watch the breadth to see what happens, or if it actually deteriorates to a point where we need to exit the market. The point being, you need to plan ahead. I shared one of the hacks that I use. I'm sure you have some other techniques, but the point is, have a plan. I have not made any changes to what I think are, exposure levels that are appropriate, which I think are somewhere in the 35 to 55% level. So the same as last week. And most importantly, don't chase extended stocks. So this week's quote comes from Mark Douglas. Mark Douglas, who wrote the book Trading in the Zone. Traders in the zone don't need to know and don't care what happens next. They need to know what they are willing to do, and that makes all the difference. So the point here is plan ahead, prepare for the pullback. That's the general market update for this week, June 23rd, 2023. Here's where you can find me, and I hope to see you next week on the next general market update.